Let's figure out from Dinanath Dubhashi then, MD and CEO at L&T Finance Holdings. How are their cash flows and their balance sheets actually shaping up? Mr. Dubhashi, good to have you on the show. Significant business momentum one has seen in farm equipment, two-wheeler, rural business finance. Will these segments continue to dominate in your share products mix in the near term?
These segments actually already dominate, and their growth will continue the way it is growing. But within our rural retail book, urban segment and urban business, that is SME segment, are quite small even today. We expect those also to grow very well. So if you see our home loan book, that is growing on quarter-to-quarter basis, home loan disbursements quite well. Consumer loans, last year, same quarter, we would have disbursed 300 crores. This year, we have disbursed 1,000 crores. And then last but not the least, SME. SME, we are just doing, book is just about 100 crores now. The pilot is over and we are launching. So actually, if you see share of the book, actually urban will increase more because urban is very small today. But the growth, large businesses, these three, tractors, two-wheelers, and especially rural business finance, they will be the bulwark of growth, no doubt. But as we said in our Lakshya, the urban retail will also help. So it's a question of, initially we having only three arrows in our, armory. Now we are having 5 or 6 arrows. That just instead of 3 products, we are pushing consumer loans, we are pushing home loans, we are pushing SME, we are pushing digital data analytics. So all this will help us grow and grow steadily. There will be times, there will be years when rural will not do well, urban will do well, or consumer will not do well, SME will do well. The good thing about having 5, 6 strong products is that the overall growth can be maintained well year on year, irrespective of which part of the markets are growing.
Good morning. What we've also seen for the quarter gone by is a 47% rise in net profit year on year and the highest ever disbursements also by the company. Let's talk about collections now. How has that been for rural finance as well as home loans? Looking at the current market dynamics, can you also share with us, given everything, your outlook, any kind of guidance when it comes for profit growth for this financial year?
So I don't give short-term forecasts, as you know, but I will try and answer your question in some ways. So number one, collections. Collections are, as I said, excellent. Collections are seen in 2 ways. One is what is on-time collection, what is the zero DPD collections. So those actually in our investor PPT this time we have given month-on-month trends, and you will see that they are all product by product. They are trending extremely well. The month-on-month on-time collections. So which makes us very bullish about collect, because if something is collected at zero DPD, that's the best time to collect, because once it slips, then your efforts to collect are much higher. So all our improvement in asset quality are because we concentrate so much on zero DPD. Also, our NPA ratios have actually improved tremendously from year to year. Quarter to quarter, it is stabilized or maybe slight improvement. We hope that that improvement will continue in the future. We have to also remember that some of the OTRs that we had done last year had come for billing, and some of it also became NPA this quarter. We are hopeful that, that we have, whatever became NPA, we have provided almost fully. We are hopeful that in Q1 and Q2, the impact of this OTR will also go away. So as we go ahead towards Q3, Q4, the asset quality will improve rapidly, and credit costs will also come down further more rapidly. So we are quite hopeful. As far as profit projections are concerned, we always talk 4 years. FY26 from the current level of little more than 1% of ROA, we are looking at ROA almost tripling to 3%. So that's the guidance we have given up in the public space. We stick to that very confidently.
Right. NIMS as well as fee stood at about 8.25% for you, which is an uptick of 71 bips for the first quarter. And clearly, we have seen highest retail dispersals as well. But going forward, how is it that you expect the profitability metrics to actually pan out given the interest rate upcycle?
Look, in Q1 this year, the interest cost in the environment went up when RBI increased the policy rates by 75 basis points, once 25 basis points, 150 basis points. So definitely interest costs went up in the environment. But we had followed a strategy throughout last year of when the interest costs were down, of booking medium-term loans, 2 to 3 years loans, and locking in our interest costs. So you will see even in Q1, when the rest of the world interest costs have gone up, our costs have actually come down by about 7 basis points, right? Now that was great. That was a bonus. Okay. Definitely, if interest cost goes up further, our cost will also go up. There is no doubt. But there are two things which are important. One, our ALM strategy, what I described, will make sure that our increase in cost is not proportionate with the kind of benchmark rates increase that will happen in the environment. It will be less than that. That we are quite confident. Also, we are confident that quite some part of it we will be able to pass on to the customer based on our business strengths. So these two things we are quite confident. Now, NIMS plus fees from 8.23, whether it will increase, I genuinely don't think so. But we are quite confident of being able to maintain in the sort of 8% range, which is very good. I mean, just about 1.5 years back, we used to guide the market between 6.5 to 7%. And today we are talking 8%, so which has happened by good retailization. So very simply, the NIMS plus fees may go down marginally, but it will be only marginal.
Now, if you were to see the capital adequacy ratio that stands at what? 23.12% to be precise. How long can the current capital last, given all of the growth forecasts also that you've been giving us? And with that, the second part of the question, any capital raising plans in the near future?
Definitely not. No plans as such. We believe that the capital will last easily over the plan period. Also, don't forget that we have entered into an agreement with HSBC to sell our mutual fund. We hope to close that transaction during this financial year. That will bring in even more capital actually. So we will not need to raise any further capital in addition.
Okay, we're going to leave it at that. Thank you so much for taking us through the fine print. That's L&T Finance for you. Bottom line grew 47% year on year. Record high disbursements. And as you can see, there's a bullish commentary also coming in from the management.